Imagine waking up one day and realizing your investments are sending you more cash every year than your job ever did. Not because you found a secret trading hack, but because you quietly built a machine that pays you just for holding great businesses. That's the core idea behind Warren Buffett's love for dividend stocks, and it's exactly what we're going to break down today in a way you can actually use in your own life. Most people think of the stock market as a casino of green and red candles, price alerts and hype. Buffett sees something completely different: real companies spitting out real cash, year after year. Instead of obsessing over every tick on a chart, he focuses on one question: how much cash can this business send me while I sleep, and how reliable is that cash stream? Dividend stocks are simply businesses that share part of their profits with you on a regular basis. You don't have to sell shares to get paid, you just own the stock and the checks keep coming. Think of it like owning a slice of a profitable store on Main Street. The store stays open, keeps selling, and a piece of those profits gets wired to you every quarter. Buffett isn't trying to flip that store for a quick gain. He wants it to pay him for decades, maybe for the rest of his life, and even beyond that for his shareholders. That's why he loves businesses with durable brands and habits: soda people drink every day, cards they swipe, phones they can't live without, energy they need no matter what the headlines say. Here's the key. He doesn't just collect those dividend checks and let them pile up in cash. He turns them into fuel to buy even more cash-producing assets. That's where the compounding magic starts. Money comes in from dividends, and instead of spending it, he reinvests it into more shares of strong companies. More shares mean more dividends next year. You've just created a feedback loop. Your money earns money, and that money gets drafted back into the game to earn even more. Let's make it simple. Imagine you invest $1,000 into a stock paying a 4% dividend. In year one, that's $40 in dividends. You don't retire on $40. But that's not the point. You use that $40 to buy more shares. Now your dividends next year are calculated on $1,040, not just $1,000. Fast forward, and each year the dividend checks get a little bigger, especially if the company raises its payout over time. Suddenly, small numbers start to look a lot more serious. Stretch that out over 10, 20, 30 years, and you start to see why Buffett doesn't need to sell shares to get rich. The income machine does the heavy lifting. Before we go deeper, if you enjoy learning how real investors build real wealth, take a second to like this video, subscribe to Dave's Dividend Lab, and turn on notifications so you don't miss the next breakdown. Now, here's something most new investors miss. It's not just about the dividend yield you see on your screen today. It's about what that yield looks like on your original cost years from now. Buffett bought some of his favorite dividend stocks decades ago. Today, the cash they send him every year is a massive percentage of what he paid back then. That's called yield on cost. When you buy a strong company at a reasonable price and it keeps raising its dividend, your yield on cost can become enormous over time. Picture buying a stock today with a 3% yield. Not exciting, right? But if that company grows earnings and increases its dividend every year, one day you might be earning 10, 15, even 20% per year on what you originally invested. And that's before we even talk about the share price going up. The stock itself might be worth several times what you paid, while it throws off rising cash flows. Buffett's approach has two pillars: own businesses that generate dependable profits, and hold them long enough for compounding to work its quiet miracle. He famously said that his favorite holding period is forever. That doesn't mean he literally never sells, but it shows you how long-term his mindset really is. He's not interested in the next meme stock. He's interested in companies that could still be paying cash decades from now, regardless of the latest buzzword in finance. So, what does that look like in practice for you, living in the United States, navigating your own bills, job, and responsibilities? First, it means shifting your mindset from "how can I double my money fast?" to "how can I build income that I can trust in 10, 20, 30 years?" Instead of chasing hot tickers on social media, you start asking different questions. Does this company make real products or services people use every day? Does it have a track record of paying and increasing dividends? Does it generate solid free cash flow? Is the payout ratio reasonable, or is it stretching just to look attractive? Buffett loves companies that don't need to reinvent themselves every quarter just to stay alive. He prefers steady, cash-rich machines over flashy stories. You can follow the same principle. Look for businesses with simple, understandable models and long histories of rewarding shareholders. Think of consumer brands, essential services, strong financials, and companies with moats, competitive advantages that make it hard for rivals to steal their customers. Another thing Buffett does incredibly well is staying calm when everyone else is panicking. Market crash, volatility, headlines screaming. He's still collecting dividend checks. When prices fall, those dividend dollars can actually buy more shares, which means more income in future years. It's like your favorite stocks just went on sale. That's one of the biggest psychological benefits of a dividend-focused strategy. Instead of seeing the market as an emotional roller coaster, you start seeing it as a giant income machine. Price becomes the tool you use to add to great businesses at better entry points, not the scoreboard that tells you whether you're a winner today. So how do you start building your own mini version of this system? You don't need billions. You just need a plan and consistency. Step 1 is usually cleaning up your financial foundation. High-interest credit card debt can crush any investing strategy, dividend or not. Step 2 is creating a small emergency fund so you don't have to sell stocks at the worst possible time when life throws you a curveball. Step 3 is where the fun begins. You start directing steady contributions into a portfolio of dividend-paying companies and funds. That can be through a brokerage account, a traditional IRA, or a Roth IRA if you qualify. The vehicle matters, especially for taxes, but the core idea stays the same. Buy quality, reinvest dividends. At the beginning, the dividend deposits in your account might look almost laughable. A few dollars here, a few dollars there. But remember, everyone who now collects serious dividend income once started with those tiny numbers too. No one wakes up with a six-figure passive income stream out of nowhere. Here's where a lot of people sabotage themselves. They get bored. They look at their small dividend payments, compare them to someone else's trades, and decide the slow way doesn't work. That's like planting an apple tree, waiting 3 months, not seeing fruit, and then chopping it down. The problem isn't the tree, it's the impatience. Right around this point, I want to pause and ask you to support this kind of long-term thinking. If this is helping, hit like, subscribe if you haven't yet, and drop a comment telling me your favorite dividend stock or ETF right now. Your engagement tells the algorithm that more people should see slow, steady wealth building instead of just get-rich-quick hype. All right, let's talk about the types of dividend stocks that can play different roles in your portfolio. You have classic dividend growth companies, businesses that might not yield a lot today, but they raise their payouts consistently over time. Then you have higher-yielding stocks, which pay more right now, but might grow more slowly or carry more risk. Buffett tends to favor strength and durability over headline yield. He wants companies that can afford to pay and increase dividends without weakening themselves. You can apply a similar filter. Ask, can this company realistically sustain and grow this dividend? If the answer feels shaky, be careful. Look for long histories of uninterrupted dividends, even during recessions. Look for consistent earnings. Look for management that talks clearly about capital allocation. Another important piece is diversification. Even the greatest investors accept that not every pick will be perfect. Spreading your dividend income across sectors, consumer staples, financials, energy, healthcare, utilities, maybe some tech, can make your income stream more resilient. When one area struggles, others might hold steady or even thrive. The goal is not perfection. The goal is a strong average. In the US, taxes also matter. Qualified dividends often get favorable tax treatment compared to regular income, especially if you hold stocks long enough. A Roth IRA can be incredibly powerful here. You contribute after-tax dollars, but qualified withdrawals in retirement can be tax-free, including the dividend income. That means you're not just building a cash flow machine, you're building a tax-efficient cash flow machine for your future self. Buffett thinks a lot in terms of optionality. Having cash flowing in gives him the power to act when opportunities appear. Your portfolio can work the same way, just scaled down. Dividends hitting your account regularly give you a chance to buy more when valuations look attractive. Instead of wondering, should I invest? Every time you get paid, you simply follow your plan and put that money back to work. Over the years, you might notice a cool shift. In the beginning, your contributions are doing most of the work. Later, your dividends start pulling their own weight. Eventually, if you stay consistent, your dividends can rival your monthly deposits. That's when you feel the system turning in your favor. Think about what that could mean in your life. Maybe your dividends cover your electric bill. Then they cover groceries, then rent or a portion of your mortgage. One day, if you stay with it, your portfolio could cover your lifestyle entirely, and your job becomes optional instead of mandatory. Is this guaranteed? Of course not. Investing always carries risk. Companies can cut dividends, markets can crash. Nothing is perfect. But building around high-quality businesses with real earnings and real cash returns is one of the most time-tested frameworks we have. Buffett didn't become one of the richest people on earth by chasing lottery tickets. He did it by owning cash machines and letting them run. And here's the part I really want you to take away. You don't need to copy his exact stocks or his exact timing to benefit from his principles. You need to copy the mindset. Focus on cash flow, quality, patience, and reinvestment. Let time and consistency be your edge. I want you to imagine your future self 15 or 20 years from now. Same name, same face, but a totally different level of financial stress. That version of you could be thanking the present you for starting with small, boring, automatic decisions that built something enormous over time. You can either look back and wish you had started earlier, or look back and be proud that you did. That choice is being made with the habits you build today. So, here's your next step after this video. Open your brokerage or retirement account, review your holdings and ask, am I building a real income machine or am I just gambling on price swings? If you're just gambling, it might be time to start adding companies and funds that pay you to hold them. Small at first, then consistently over time. Remember, every dividend check, even the tiny ones, is a brick in a foundation that can support you for the rest of your life. If this episode of Dave's Dividend Lab helped you see dividend investing the way Buffett does, as a quiet, powerful cash flow system, do one last thing for me. Hit like, subscribe to the channel, share this with a friend who needs to stop chasing hype, and then click on the next video on your screen, where we'll break down how to design a dividend portfolio step by step.